All right, let's get straight to it. Today is Wednesday, December 10th, 2025, and what happens in the next few hours is absolutely pivotal. The decision this afternoon is going to set the tone for the entire market over the next year, so let's pay very close attention. Okay, before we dive in, our standard disclaimer. You know the drill. This briefing is for educational purposes only. It is not financial advice. Every investment decision you make carries risk. All right, with that out of the way, let's get to the numbers. This is the only number that really matters today, 87%. That's the probability the market is assigning to a 25 basis point rate cut this afternoon. Now, let me be crystal clear. When you see conviction this high for a decision that is this unusual, well, that's a massive red flag. And that brings us right to the heart of the matter. We're calling this the Fed's blind cut, and for a very simple reason. The Fed is making policy with absolutely no data. This isn't your standard run-of-the-mill FOMC meeting. Make no mistake, this is a gamble. So as you can see, the market has priced this in as a near certainty. We're looking at a third cut in a row, which would push the Fed funds rate to its lowest point in 3 years. But here's the thing, the data just isn't there to back this up. So the real question isn't if they're going to cut. The real question is why is the market so convinced they will when it flies in the face of all conventional logic? And this really is the core of the problem. Think about it this way. The Federal Reserve is trying to steer a $28 trillion economy without a speedometer. Because of the government shutdown, we've had no official jobs numbers, no inflation data for 2 straight months. They are flying completely blind. This has never happened before, and frankly, it's incredibly dangerous. This chart right here just highlights the fundamental conflict we're facing. The last piece of official data we actually have showed inflation running at 2.8%. That is well above the Fed's 2% target. I mean, Standard Monetary Policy 101 says you hold, maybe you even hike. To cut rates right now is a direct contradiction of their entire mandate. So it begs the question, right? Why on earth would you cut rates during a data blockout when inflation is still running hot? Well, if the data doesn't justify it, what does? The answer, unfortunately, isn't found in any economic model. It's found in politics. What we're all witnessing right now is a head-on collision between monetary policy and raw, unfiltered political pressure. The independence of the Federal Reserve, it's being tested in a way we have not seen in the modern era. Period. And look, this isn't subtle. It's not subtext. It's a direct public threat. The pressure on Chair Powell right now is absolutely immense. That one statement has fundamentally changed the entire risk landscape, not just for the Fed, but for all of us in the market. Okay, this timeline is absolutely key to understanding how the market is thinking about this. Powell's term is up in May 2026. That effectively makes him a lame duck chair now. The market isn't even really focused on him anymore. It's already looking ahead, pricing in his replacement and the agenda that's coming, and that means the inflationary Trump Trade 2.0 tariffs we all expect in early 2026. So you've got Powell trying to cement his legacy while the rest of us are bracing for a major policy shock. So here you have it, 2 dueling agendas. On one side, you've got the Fed, or at least Powell, desperately trying to cement a soft landing legacy. On the other, you have immense political pressure to force aggressive cuts, no matter the risk. You know, the market hates uncertainty, and we just got a double dose. Policy uncertainty from the Fed and political uncertainty from the White House. So the real question is, how do we position our portfolios for this? Because analysis is great, but capital allocation is how you generate returns. The old playbook is out. The new playbook for the next 12, maybe 18 months has to adapt to this new regime. The consensus on Wall Street is shifting, and shifting fast. The theme is no longer growth, it's survival. The base case forecast is for what we're calling a stop-and-go Fed. That means politically motivated cuts now, followed by emergency hikes later, probably mid-2026, when the inflation from those new tariffs really starts to bite. So the crucial takeaway here is this. The rotation is on. The smart money is moving out of high beta tech, the high-flying, volatile growth stocks that did so well in the last cycle, and they're rotating into real assets. We are now positioning for a stagflationary environment, which, as you know, is incredibly hostile to a traditional 60-40 portfolio. And you can see that rotation happening in real time right here. Capital is pouring into assets that can actually hedge this kind of risk. You see Bitcoin rallying past $92,000, acting as a clear hedge against this exact kind of policy error. Commodities and energy are firm because they're physical assets, they're inflation resistant.
The bond market is already signaling a reflation scare. That's the fear of inflation roaring back. And even the speculative money is on the move, with altcoins like Cardano seeing big inflows as traders look for any way to find alpha in all this chaos.
And this really leaves us with the one defining question for the next year. This whole soft landing narrative that we've been hearing about for so long. Is it real? Is it a masterpiece of prudent policy? Or is it just a political fiction that's about to slam headfirst into reality? The decision the Fed makes today will give us our first real clue. That concludes this special briefing. And again, just to reiterate, this content is for educational purposes only. It is not financial advice. We will be monitoring the Fed's decision and the market's reaction very, very closely. Thank you.